So if the goal is to not have to work the rest of your life, or at least have the freedom and control to be able to determine how much you have to work at some point in your life, to control your financial means and to control your time, then ultimately at some point in time, you'll have to accumulate assets, enough assets to be able to sustain you financially without having to trade your labor for money. If that's the case, buying assets is going to be centered around the success of buying assets. It's going to be centered around what you purchase those assets for relative to their future potential. And nothing is going to influence that more directly than interest rates at the time of you purchasing that asset, to be honest, especially if it's one of the time-tested, proven assets that are most popular and common to us today, stocks and real estate being the most common. There's others that fall in that category. You have to purchase them at the right price relative to the economic cycle. And honestly, interest rates are a huge predicator in where we are in the economic cycle. I can tell you right now, assets will probably not be any cheaper in this economic cycle at the time of this recording in late June of 2025 than they are right now. Basically, what I'm saying is that it is time for you, if you're not already in position in doing so, to get serious about acquiring assets like stocks and real estate now, while they are at the price range they are at, even if you think they're overpriced or overvalued, because they're not going to get any cheaper. And I'm going to explain in this video why. So for those of you who are new, I'm JP. I'm the architect and founder of this channel. 13 plus years in financial services, 11 plus years in retail banking. I have a mortgage license, FINRA investment license, life insurance license, and I'm small business certified. I've been doing small business banking for the majority of my working career. So consumer banking, small business banking, you name it. The goal on this channel is to help you master relationship banking, maximize your borrowing capacity, because those foundational pillars help you customize your blueprint for prosperity. Once you navigate the banking system and the financial system effectively, that leads to you being able to acquire assets through effective borrowing, etc. And that leads to you, as I said earlier in this video, being able to control your time and control when or how much you work at some point in your life. All of that having been said, if you're looking to control your time and control your means, you come to the right place. So why am I making this video around it's perfect? This is the perfect time or the ideal time, given this economic cycle, to acquire assets. Why am I saying based on valuations, pricing, this is the time? Well, let's first back up a little bit and be clear and define what assets are. Assets are items of value that an individual or business owns or controls with the expectation of providing future economic benefit. They can be tangible, like real estate or equipment, intangible, like patents or trademarks. Assets are crucial for determining net worth and financial health. So we talked about tangible assets, intangible assets, financial assets, stocks, bonds, and other similar financial instruments. At the end of the day, you need to own or control a significant enough amount of these assets in order to be to outvalue your labor at some point in time. And again, the mechanism that makes that work is going to be the pricing or the valuation you acquire that asset at based on its potential future growth over time. So at this point in time, interest rates are the highest they have been for about 20 plus years or so. We're looking at interest rates based on the Federal Reserve's Fed's fund rate that have us in a place unique to where we've been in this generation and in this lifetime. This economic cycle has changed significantly just since 2020 to the time of this recording at 2025. We went from going into 2020 in a moderately normal cycle, which was the same cycle we were in, call it 2009, 2010, 2011, until 2019, late winter 2020. COVID struck us in around February or March, changed that economic cycle. We had a scenario where COVID had us drop interest rates to historic lows. A lot of money was pumped into the system. That inflated assets, inflated the cost of goods and services. The Federal Reserve eventually responds in 2022, starts to raise interest rates to taper off that inflation and stem that growth. There's a ton of money flowing through our economic system. Rates are really low, making borrowing cheap and spending plentiful. The Federal Reserve says, okay, we need to back up, try to pull some money out of the system through their quantitative tightening, and then raise interest rates to limit or stem the tide of borrowing, which pumps money into the system and creates money out of thin air, essentially. So we've been in that 2022 cycle, late 2022 cycle, up until right now, essentially at the point in time of this recording, which is going to be summer of 2025, excuse me. That cycle is likely coming to an end. Now, I have been wrong in the sense of trying to time this with interest rates since 2024. I'll be the first to admit that. If you catch my videos in summer 2024, fall 2024, you will hear me saying then that rates should likely be coming down. At the end of the day, none of us have a crystal ball, so timing is not going to be accurate for hardly anybody. But the concept that rates are going to change and have to come down at some point, and inflation will be the chosen economic cycle again, is a fact. That is a matter of when, not if. So no, I wasn't right on timing, saying it, and partially wasn't right. Rates did get cut a couple of times at the end of 2024, but I was expecting it to be a consistent cycle a little bit earlier and continue on. That didn't happen, but that cycle is coming. I want to get to the baseline of why it is important for you to understand that regardless of timing, getting in now while it is hard, getting in while rates are high, and pressing down on asset valuations, regardless of the fact real estate in your market may be growing, regardless of the fact your stock portfolio may still be doing well, I promise you there's still downward pressure on those assets. I can assure you that at some point in time, sooner than later, that is going to change. The Federal Reserve and the entire financial system will eventually default back to inflation, lower rates, and quantitative easing, allowing money to be pumped into the system again. It is a natural economic phenomenon that has to persist. Now, whether the Federal Reserve is going to do that soon, how aggressive they're going to do that, we don't know yet. But what I can tell you is that for you trying to own assets, it is important for you to get in right now, because this is as close to the bottom as we can time or we can predict that to see as you're going to get. Maybe the rates stay higher for a little bit longer. Maybe they go all the way through 2025, maybe into early 2026. Who cares? At the end of the day, rates will lower. Borrowing will pick up. Spending will pick up. Economic activity will pick up, meaning asset evaluations will pick up. Asset valuations will pick back up, and they will pick up beyond where you're buying it at, the baseline that you're buying it at. So as I said, the timing is essential. The price that you grab that asset at is essential. This is some of the most downward pressure we're going to get. And I want to break down why inflation is baked in and guaranteed to kick in and be the choice. If the economic system and the Federal Reserve has to choose, they will eventually at some point choose inflation. And I want to explain to you from official search definition why so. The Federal Reserve doesn't want inflation in the sense of promoting it as a positive outcome. Instead, they aim for a low, stable, and predictable rate of inflation, typically 2%. We see how that worked out. This target is considered beneficial for a healthy economy because it helps to prevent deflation, provides flexibility in monetary policy, and encourages economic activity. So a more detailed explanation is avoidant deflation, which is essentially falling prices, which is harmful for the economy. I kind of shot another video about that in the past. Not going to go too far into that one. Monetary policy flexibility. A small amount of inflation allows the Federal Reserve to lower interest rates during economic downturns to stimulate borrowing and spending, as I just illustrated and described. Facilitates real wage adjustments. In a healthy economy, some businesses may need to reduce real wages adjusted for inflation to remain competitive. So a little bit of inflation can make this process smoother as it allows real wage adjustments without requiring nominal wage cuts, which can be unpopular. So basically what they're saying is it is a silent tax on your income. Instead of companies literally taking you from $25 an hour to $23 an hour to allow themselves to be more competitive by cutting down their expenses, which is your salary, your income, the inflation basically makes that reduction for them. And it's not nominal. So it's not something you see on paper, so you're okay with it. That's basically what that means. Preventing stagnation, which is a whole other video topic. Low inflation can encourage businesses to invest and expand as they can anticipate their products and services becoming more valuable over time. It also encourages consumers to spend rather than to hoard cash, as their savings will not grow in value as quickly as goods and services. They're telling you that they see, by definition, inflation on some level as a healthy mechanism of the economy. So right now, there's still inflation. That hasn't gone away at all because rates are up, but they're suppressing the capacity of that inflation at the moment. Even though it is not down to the 2% target range, it's gone from the official numbers of 9 plus in 2023, I believe, down to 2 and some change at the time of this recording. That same inflationary rate is influencing the value of your assets, as they just stated in the last sentence that I just read. Goods and services, that includes assets. Companies that you're investing in, the stocks, they're the ones providing the goods and services. So when the goods and services become more expensive or higher value, the valuation of the company tends to go with it. Same thing is going to be for real estate. It's a commodity in the system, or it's a product or a good that we all consume on some level, and it's going to become more valuable. So what I'm trying to tell you, and maybe I'm being long-winded and saying, is that whether we, myself as a finance creator or anybody else, gets it right on timing or not, we are all correct. The ones of us that are educated and tell you that, ultimately buy the dip, buy low and sell high, or buy low and hold on forever, to be honest. It doesn't matter if we're spot on timing or not. What we're telling you is still very applicable. Take the cash you have, take your income. Don't sit on it because rates are up. You're not Warren Buffett. You're not Jeff Bezos. You're not ultra rich and able to sit in cash and wait to buy multi-million, multi-billion-dollar businesses. That's not your financial situation. 9 out of 10 times watching this video, the majority of you are like myself. You're anywhere from working class, middle class, maybe upper middle class, and you're playing the same game as the rest of us. What that basically means is you don't have the ability, you don't have the luxury of sitting in cash and just earning a better interest rate and hoarding off to the side. You need to be picking up assets right now while they're suppressed. You need to be picking up assets while the downward pressure is here. Because even though real estate may still be growing in your market, even though your 401k, your stock portfolio may be going up, it's not going up at the same rate it will be going up when the Federal Reserve finally cuts rates consistently. It's coming. It's baked in. I'm telling you, I'm reading it to you. It is baked in. They're going to cut rates. And that is going to lead to inflation at some point picking up, asset valuations picking up. People will be able to borrow more money. Companies will be able to borrow more money. When you borrow money, you're borrowing typically to spend. And when you spend, you're pumping it into commodities, goods, services, assets. That means more money floods into the system, and is going to be chasing a similar or fixed amount of goods and services, or products, goods, and services. Or those products, goods, and services will not be in supply, keeping up in supply to the amount of demand that will be out there. If you want another example of what I'm saying in English, the housing market. There will not be enough homes built fast enough for the amount of people that are going to want them, and now with rates down, be able to afford them. They can borrow more money at cheaper rates and afford more homes. It's going to allow more people. This is exactly what happened in 2020, 2021, and 2022 when housing prices went astronomically through the roof for that period of time. More people were able to borrow because rates were extremely low, historically low. This put the people that would normally maybe only be able to afford a $150,000 house based on their financial metrics and the underwriting. Now they can afford a $250,000 house. And that number extrapolated for everybody. So you have people that couldn't even buy a home that can buy. You have people who could only buy a starter home that can buy a mansion now, or an upper middle class home. That is the same scenario on some level that will play out again. All of that basically means that your cash will for sure continue to lose its purchasing power. But the assets you can put your cash into are possibly as cheap within this economic cycle as they're ever going to be going forward for the foreseeable future. So hopefully that makes sense. This is a bit of a PSA and a warning of simply saying, don't sit on your ass. Don't sit on your hands. This is a time for you to take your excess cash flow, your side hustle money, whatever cash you may be laying on, Get in, double down in your stock portfolio, your 401ks, buy more real estate, make the real estate you own more valuable, like add on, do additions, move around and get in assets, whatever those assets typically are that are time tested and proven and sensible. Get into them now because they're only going to go up from here. Comment down below and let me know, do you understand what I'm putting down in this video? Comment down below and let me know what your economic or financial strategy is, your investment strategy may be around assets and acquisition right now. Are you aggressively building up your cash to buy assets? Are you buying assets? Let me know where you are down below. And maybe if you want to go a little bit further, let me know what level of assets or net worth you're looking for to be able to stop working or have the ability to start working. Comment that down below. That would be very interesting to know. To all my pioneers, welcome back. To my new viewers, welcome in. I want you to like, comment, share, subscribe, support the channel. So, of course, the channel can continue to support you. Get in the links in the description down below. There are a couple of links. One is going to bring you to the Instagram page of the channel. We're slowly but surely building our content there, growing our committee of pioneers there, that we can share ideas, share experiences, and continue to grow together across platforms. I want you to drop in the description as well for opportunities to work with me one-to-one. Many of you are in a position where you have plans, goals, and ambitions, but you don't have answers. You don't have a full laid out, curated roadmap. You don't have the guidance or the information you need to act decisively. I am available for that. You can get in the description down below and find out the various ways that I specialize that will work for your financial needs and goals, and work with me one-to-one. I will definitely work with you and help you get where you're trying to go financially. Other than that, as always, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.